Hello, everybody. Welcome to Talk About House. I'm Todd.
I'm Juana.
We are, as you can see, we're getting over our Tahiti sunburns.
Yes.
So it's been a few days, but we still have a little bit of the sunburn going on. Okay, we are going to talk about 2024 and expectation being off the chart, not only for the housing market, but for the economy.
Okay.
Now, Juana, first of all, before we dive into the article, we got a ton of charts. So so there's two things. There's like economic reality, right? Mm-hmm. There's what's actually happening. And then there's what people believe are happening, right?
Right.
This expectation. So I'll give you an example. A year ago, almost all of 2022 and most of 2023, people would come in the comments and say, we're already in a recession. Like we're in the recession now. We're watching the recession happen in real time. And here we are a year and a half later. And all we've had is economic growth. We haven't actually had any recession, mm-hmm. But people, at least at some point, felt like we're in a recession for some reason, probably watching too many Crash Bro videos. Why is expectation important?
Well, expectation is important because it's kind of like your parents said to you when you were growing up, right? If you hang out with good people, you're going to be a good person. If you hang out with people who do naughty things, you're going to do naughty things. Well, it's the same thing. It's the same thing with expectations. Those self-fulfilling prophecies, right? If you believe that we are in a recession, then you are less likely to spend money, and you're less likely to engage in commerce altogether, which of course is going to lead to a recession. So that's why how people feel, their sentiment, is important.
Yeah, you know what's funny is, if you look at any year where real estate prices go up substantially, and you ask people, what do you think next year will home prices go up or down? They almost always say up. Oh yeah, home prices are going up like crazy. They're going to go up next year too. And if you get a market where you have home prices going down and you ask people, what do you think home prices, they'll say, oh, they're going to keep going down. People tend to believe what's currently happening that will continue to happen.
I don't know that they believe that as much as they don't want to be wrong. So if they stay with the status quo, then they're more likely to be right.
Yeah.
So I think that there's this huge sentiment that people have that they just don't want to be wrong. That's why people follow other people. That's why people are lemmings, because they just want to go with the crowd because they think that the crowd somehow knows better than they do. And my sentiment is, and of course I use that word on purpose, that we all are reasonable people. And if we just stop and look at the numbers, look at the information that's actually available, and make an evaluation of it and decide for ourselves, what do we think? I think the sentiment people might have more trouble with that.
Yeah. Okay. So this is a bunch of data. We'll start with this first slide here. 2024 looking better than before, meaning better than before, like 2023, basically, right? Mm-hmm. Okay. All right. So we're going to go through a bunch of data to talk about it all. Okay. So this is from the RCLCO. It's the Real Estate Consultants something. Current Real Estate Market Sentiment Index, which is measured on 100-point scales, remained flat over the past 6 months, ending at 1547 at the end of 2023, just a few days ago. A nominal decrease of just 3.5 from mid-year. Now remember, this is on a 0 to 100 scale. So 100 is, oh my gosh, it's great. It's panacea. And 0 is like Crash Bro.
Right.
Okay. All right. The index remains decidedly in the zone, indicates challenging real estate market conditions. An RMI less than 40 is typical, consistent with a period of real estate market distress / recession. These are beliefs.
Right.
Now, people believed that last year, but we happen to know that in the top 50 markets, meaning the largest 50 markets, mm-hmm. right? The largest 50 markets in the U.S., home prices in 2023 went up in every market except for one.
Right.
And do you remember what market that was?
I don't.
Austin.
Okay.
It was in Austin. Austin, Texas had some declines. But remember, Austin blew up like 60%. So
right.
It had the highest up and down. It sort of rode a little bit away. Okay. Before we show the chart, on a decidedly more positive note, a large share of respondents predict that real estate market will be better over the next 6 to 12 months. The future RMIs predicted increased sizable 29.7 to 45.7 over the next 12 months, presaging a rise out of the zone of distress within the next year. Okay, so here's the chart. This is this market index. Now, the blue is the current, what people currently believe, and then this gold-colored, yellow or orangish-colored one is the predicted one. As you can see, the predicted one pretty much is pretty accurate. It's a pretty accurate predictor, just people's sentiment. And this goes all the way back to 2011. So you can see for most of the time, of course, 2013, 14, 15 were great times because home prices were super low, right? And then just like any other chart you look at here, once you hit 2020, it kind of goes crazy. Like whether it's stock market, indexes, interest rates, inflation, all that, right?
Right.
GDP growth. Okay. But looks substantial. I mean, this is a massive increase in sentiment. Do you think this could sentiment on its own make a difference in the housing market, say, in the next 6 months?
Yes.
Okay, why is that?
Because it influences behavior. So if you believe that home prices are going to do X, you're going to behave in a certain way, which will generally result in the home prices doing X. So if people believe that home prices are going to skyrocket, and people will go out there and they will buy homes and they will push prices up and they will go into bidding wars and offer more money for the house and that sort of thing because they believe that home prices will go up. If people believe that home prices will go down, then they're going to sit on the sidelines and wait for home prices to go down. Well, if you don't have any buyers, then home prices do go down. So yes, I mean, I think sentiment is very important. This is why the government tracks sentiment on just about everything. Because if you think about it, like, what is the government doing tracking sentiment on just about every metric? But that's what they're doing, is they're actually trying to figure out what people think and what people feel, because that is generally a predictor of behavior, not of what the economy will do, but what people will do. And based on what people will do, that's what happens in the economy.
Your sense of emotional, whether it's fairness, your current emotional state, what you believe your future is going to be, are far greater than reality. Like, your emotional state will override your reality anytime.
Right. Law of attraction, people.
It's law of attraction, almost. Okay, here's another chart. This is interesting. This chart also goes back to 2011. This is the 12-month U.S. real estate market predictions over time. Now, what each of these are, okay, every one of these adds up to 100. Okay, now the red line is a moderately or significant decline in real estate. The green is a moderate or significant increase, and yellow is unchanged. So you can just follow each one of these lines. People thought, for the most part, from 2011 to about 15, that real estate was going to do very well, and the people who thought it would be unchanged or not very well was very low. And then, as you can see, we got into 16, 17, 18, 19. We had a lot of uncertainty, right? And then, of course, 2020, we had, the opposite. So people thought it was going to be terrible, then they thought it was going to be great, and then they think it's going to be terrible again. Now they think it's going to be getting better. We've been riding this roller coaster because human beings, there's this book called Predictably Irrational, and it kind of explains how people think and believe. But what's interesting is people actually have a very poor ability to measure value or predict value of anything. And they tend to use this thing called comparison. So in getting comparison, they also compare their opinion to other people's opinions, which is why propaganda is an extremely powerful weapon. Juana, you grew up in a communist country, right? What is propaganda? What does that mean? What does it do?
Well, it's meant to influence people, and regardless of what form of government you subscribe to, they've all used it. And if we leave governments out of it, let's talk about advertisers, because that's what that is, right? When they're pushing some product at you, it is propaganda. because that product may or may not do the things that it's supposed to do or that it's advertised to do. But the idea is to get you to buy off on something.
Okay. All right. So the next sentiment, also on the rise. This is good. A growing share, 29% of respondents believe national economic recession is unlikely in the next 24 months. Although a substantial number believe that we are either currently in a recession or will be one within the next year. 37%, a smaller share of respondents believe a recession is more than a year away. Here's the chart. You can see it. So the gray all the way on the right is unlikely, which is a pretty high number.
Mm-hmm.
And then you have the people that think we're in one, and then how long they will be off. Now, what was interesting is if you had done this 24 months ago, the people that say unlikely next 24 months would have been wrong. Everyone else would have been right. Everyone else would have been wrong.
Right. So here's the thing. Right now, it's easy for all of us to say it's unlikely, right? Interest rates are going down. Inflation is going down. Unemployment is at an all-time low. Look, things are pretty good. If you leave the national deficit out of it and the national debt out of it, things are just peachy. So it's pretty easy to say things are going to be great for the next, 12, 14, 20 months, whatever. And that's great. So it doesn't take a genius to figure that one out.
Here's another chart. What do you believe the depth of recession will be? So it's about 23% all the way on the right, that dark color. Not applicable because there will be no recession in the next 24 months. You had about 34% say a shallow 0 to -1%. Moderate was 37% said moderate. And then you had about 5% say deep. Okay. That would be -2% GDP. These are definitely crash bros.
Right. So, okay.
They live in here.
So 24 months is actually a pretty long period of time. And in 24 months, the idea that we would have, 2 back-to-back quarters of negative growth, that's a distinct possibility. And that doesn't mean that the economy is in trouble. It doesn't mean that we have a bad economy. It just means, it could be something, like I said, something such as supply chain or some other event that precipitated that. But it doesn't mean that it's a bad economy, and it doesn't mean that overall the economy isn't booming.
Right. Okay. Here's another quote. The majority, 53% of respondents said the interest rates will decrease at a moderate pace, and 35% predict that interest rates will remain the same. This represents a large shift in expectations, as a majority of respondents in mid-year 2023 expected rates to increase compared to 11% at the end of 2023. So we've had what have been the things that have happened at the end of the year? And actually, I'm going to put this chart up while we talk so they can see it. This is what do you think the Fed 10-year Treasury will be 24 months from now? So you have that unsure all the way on the right. The biggest group of people is 3.5 to 4%. Currently, it's about 4.3%. The 10-year Treasury, right? Yes. About 4.3. So you have some people who say it'll be up above 5, not many, 4.5 to 5, but most of the people think it's going to be between 3 and 4.5.
Right.
That's the on the bell curve. That's where people are guessing.
Right. So it's interesting because the sentiment was actually really accurate. Because when people said, "Hey, at the beginning of 2023, that interest rates will continue to rise throughout 2023," they were absolutely right, because they didn't start going down until the very end of 2023. So they were right. And a lot of us think that interest rates will moderate in 2024. I don't expect that they're going to hit 3%, but interest rates are definitely going down. How far they're going to go is left to be seen. I'm not as I don't think the Fed is going to be that aggressive in their interest rate cuts, but that doesn't mean that the market won't price that in and reduce interest rates at a greater pace than the Fed. And I think that's an important distinction, because remember, the Fed has not lowered interest rates, yet mortgage rates have gone down, right?
Yeah.
So that's what I'm saying. The market will factor in what the Fed will do, and will step ahead of the Fed and anticipate and reduce rates. So while based on the Fed rates, we can't see 3% by the end of the year, the market may say, hey, you know what? We don't care what the Fed's doing. We think this is what the market will bear, and we're going to be at 4.5 at the end of the year. I mean, I'm just making that as a point. I don't know that interest rates will be at 4.5 by the end of the year. I think they're going to be closer to 5, but I'm just making a point.
Yeah. Okay, here's the next quote. This is about their expectation of GDP growth. U.S. GDP growth to end 2023 stronger than anticipated at 1.5 to 2.5%, with slowing between 0 and 1% predicted in 2024. This is that soft landing. Mm-hmm. So the recession or inflation goes down, the economy keeps growing, but we don't actually sort of go negative, okay? Depending on inflation and geopolitics, the U.S. economy will likely return to trend 2 to 3% growth in 2025. Job growth will moderate to 2.5 to 3 million in 2023, though is expected to decline in 2024 to 0 to 1 million, possibly turning negative for parts of the year. As the economy slows, U.S. real estate fundamentals will continue to soften, with moderately higher vacancy rates and slower rent growth in both property types.
Okay, so here's my question. Barring the economics, but just the reality on the ground. In order to have higher vacancy rates, you have to have less people needing housing. And we've established that we have more people needing housing, that we have insufficient housing. So I'm not really sure where this higher vacancy rate fits in with our current situation of not having enough housing for everyone.
The number of apartments built in the last 12 months, apartments, is the highest percentage or whatever level in like 36 years.
Right.
They really went now, but two things have changed. The number of building permits for multifamily has dropped off a cliff.
Right.
And remember this too, a rental is not really competing with a home, because people say, oh, but they'll just live in an apartment or whatever. If you're creating a household, say marriage, children, or you want to live in the suburbs or have a certain lifestyle, you're not going to want to live in an apartment. If you live in a city, that's great. But for the housing market, we talk about houses, it's similar, but I could argue, well, they made a bunch of cars, people just go live in their car, and that'll crash the housing market. All these cars, that's the one thing that Crash Bros have never said. Oh, the car manufacturers, when the people will realize they can live in their car, and then they just won't buy a house, and the housing market will crash, along with all the boomers dying in the next 3 years for some reason, which would be, pretty crazy.
Right. Okay.
Yeah.
Do you have anything else?
No, I just wanted to talk about this because there is almost no prediction that job growth won't continue, even in a recession.
Right. So, I mean, job growth tends to continue anyway. It's very rare that the jobs really contract. And remember, who's the biggest employer out there?
The government.
The government. And when was the last time the government shrunk in the U.S.? I don't know. A lot of us can remember that. I'm not even sure that it ever has.
Oh, I know.
When?
The last time it happened was probably at the end of the Vietnam War, because the military contracted, because they drafted a bunch of people in.
Right.
You could argue the same thing, the Korean War maybe, certainly World War II.
But I'm not talking about military.
Well, it's part of the government.
It is part of the government, but I think the military is a separate issue. I'm just talking about bureaucrats in general.
Argentina.
Yes, I said the U.S. I was very specific
Argentina's
about that.
Just got...
I knew you were going to say that.
Argentina.
I knew that. So my point is that, remember, government isn't just the federal government. You've got the county and the local and the city and the state. And so there's a lot of that's why we say government is the biggest employer. So the idea that, the biggest employer is going to somehow get smaller, I'm not so sure about that. So because of that, as much as maybe some of us are not so fond of that, you do have to understand that they do stabilize employment. So I think that's an interesting thing to think about.
Keep talking.
Oh.
I'm going to check something.
Oh, you're going to check something. Okay, fun. Okay. So this is Todd on the fly.
Yeah, I just thought, I saw a stat and I want to get the exact number.
Okay.
Okay, you ready for this?
Okay.
Okay. The city of San Francisco. It's a city. Mm-hmm. It's got, what, 700,000 or 800,000 people in the city, right?
Yeah, somewhere in there.
The city. It's actually city's pretty. No, the whole Bay Area's got up. The city of San Francisco, right. 700,000 to 800,000, right? They have 28,000 government, city, only city employees.
Yeah.
28,000.
And then there's the county.
Yeah, and then there's county, and there's probably the post office, which is federal, right? And all that. So you have tons of people.
And the state of California, people that are also part of the government that are in the city too.
Yeah, it's crazy. So when you say, and when was the last time the city of San Francisco shrank the government? Probably not going to, right?
No. So I'm making the point that the government actually does provide a stable workforce in that way. So that's part of the reason why we do have stable employment.
Yeah, and if you want to see something interesting, especially if you're in a small town that doesn't have like one massive employer in it, go on Google and search how many, what are the largest employers in, Mike Blank County, right? Or in your city or whatever, and look and you'll probably be able to find it because all that's tracked. And you'll probably, if you have a military base anywhere near you in your county, for sure it's going to be the military base.
Right. Yeah. Well, and then of course everybody that supports that. Yeah. Because anytime you have a large employer, you have all the businesses that provide support for that, and of course all those businesses have employees and so on. So it's kind of an interesting way of looking at it. Anyway, we kind of digressed, so sorry about that.
No, my point is this. The best thing that can happen for the real estate market is the economy do really crappy and the Fed to start taking rates, and then the forward-looking market to say, look at rates tanking. By golly, we're going to be back to 0% rates. Let's loan out money while we can at these high rates before they drop anymore. Because think about it. If you think prices of any asset are going to go up, you buy, right? Would you buy? If I told you we're going to do all this thing and make home prices go up, or a stock, you would start buying the stock because you would want to accumulate something you believe is going to go up. If you've got money to loan out to people and there's an interest rate you can charge, and you are seeing in the future this potential of really low interest rates, then you want to loan out as much money as you can now. You want to get the money out while you can. And when you're doing that, it's going to get super competitive. So the market takes that into account, and then people start competing on rates. And that's literally why the 10-year Treasury and all these other rates they're market driven. They're not set because the government can't just say, oh, we want you to pay 4% for this thing. People go, no, I don't want to pay it because, I'm just not going to pay 4% for this bond. So people say, well, what will you pay? What kind of interest rate are you willing to pay for this thing, right? That's how it works.
Except when you go to DMV and you don't have a choice.
The DMV is pretty bad. Nobody has a good experience at the DMV. We apologize if you work at the DMV. We know it's not your fault.
Yeah, I actually feel really sorry for the DMV people. We were there not that long ago, and those people are just so stressed out, and I just feel so bad for them.
New plates for the Cybertruck.
Yes.
Yeah. His and her Cybertrucks. We'll do a video with the Cybertrucks.
We need a lot of tips for Cybertrucks, guys. We don't have Cybertrucks.
No, we don't have Cybertrucks.
So please remember to like the video, subscribe, hit the notification bell, share the video, leave us comments, tell us to stop going off track and stay on topic. We're totally fine with that.
No more snorkeling in Tahiti.
Please feel free to give us your ideas for real estate video topics. We welcome your comments. We appreciate you watching. We appreciate you subscribing and hitting the notification bell. We appreciate you sharing the video with others and helping the channel grow.
Good.
We'll see you on the next video. Bye.
Bye.